Welcome to TMS Insights, the first of 2014. Hope everybody's had a fantastic break over Christmas and the New Year. We're certainly looking forward to it. Jeremy Hook and Ben Clark looking forward to bringing you many of these sessions through 2014. Ben, a little knock on the head, surfing perhaps?
Yep. It's been a good start to the year, and you've time off with the family. You've had a good break.
Yep. And we feel a lot better than the English cricket team, I'm sure. So,
absolutely.
But getting into the year, it's an interesting time of year for us. We do get busy in different ways in January ahead of what is quite a busy period for February with reporting, Ben.
Yeah, absolutely. I mean, a lot of companies are in their blackout period, which is where they'll be finalising their accounts at the moment. The accountants will be coming to them and saying this is what the numbers are for the 6-month period last year from July to December. Generally, not a lot of company-specific announcements at the moment to the market, and you probably don't want to see too many from companies we own, because this is a time that is called the confession session, where companies, if they become aware that they haven't met the expectations that they set themselves, they will come to the market and issue a profit downgrade. And we've seen a couple already from Super Cheap Auto.
That's
got
right.
hammered after a pretty nasty profit downgrade. They, of course, own Rebel, BCF and Super Cheap. But coming into February, it's going to be a very, very busy period.
We go flat out then, and there's no rest at all. We have our main reporting season. Some of the bigger ones to watch. Commonwealth Bank's the only one of the big four banks that reports in February. We'll get quarterlies from the other three. Telstra's big, Wesfarmers is big, but most companies are either half year ended December 31, so we'll report, or many are in fact as well year end Dec 31. So it's certainly busy, and we'll do all our visits to companies, we do our teleconferences and all through that period. So right at the moment, the main thing that we try to do is try to get on top of where the hotspots might be, and we do a little bit of extra work and research. So it keeps us quite busy in terms of preparing for what is coming up in that February season. One of the things we're also very conscious of is how the themes tend to change at the start of the year.
Absolutely. And we've sort of been talking, having a think over the Christmas break and talking in the new year. And, one thing I think personally will be a theme of 2014. 2013 and the second half of 2012 was all about the yield trade. And certainly we saw it amongst our clients. Everyone was looking for a better return, realising that the cash rate was going to fall heavily. We saw a lot of company share prices run up purely on a better the dividend prospects of that business. My view, and I think Jeremy, you agree, is that that is going to show signs of petering out this year, and the market's attention will return to earnings growth, which is generally what it is.
In most times of the cycle, that's the case. I mean, this was, if you look globally, there was a money-fueled boom, and in the equity market, a yield-fueled boom as well. The easy gains in the Telstras and the banks are not going to be had unless they're delivering earnings growth. And that's, like you said, Ben, how it normally is. So this will actually be a stock picker's year to some extent. And we'll be talking about individual stock stories to our clients because of their earnings growth, rather than a simple yield trade. And we don't want to get too hung up on just the yield. So even a company that's paying 3.5% with franking takes us to 5% grossed up. That's excellent, because we don't expect interest rates to be very much higher through the course of the year. So the relative yield from a stock of that sort of dividend is actually quite excellent.
And that will be something that will, I think, almost certainly happen this year, is US bond yields will probably rise quite strongly, which means that international investors who saw a 5.5% unfranked dividend yield from Telstra as attractive, if US bond yields push up to 4 to 5% this year, and that's effectively a risk-free return, that return from Telstra will suddenly not look nearly as attractive, and that could be a bit of weakness in the share price there.
It doesn't mean it has to be a huge amount, but it just loses a fair bit of its buying. One stock that we do think, though, is of interest right now, we've done some work on lately, is Car Sales, a company which has got a lot of appeal.
Yeah, absolutely. And Car Sales, Seek has been a great business. We've promoted to clients over the last couple of years. Car Sales is a similar business in terms of what it does, but of course it operates in the new and second-hand car market. And this stock's actually had about a $2 pullback over the last couple of months, despite reaffirming its earnings guidance at its AGM in October, and it's drifted back to where we think is now quite attractive valuations. Now
it's around $9.50 at the moment.
$9.50. It did get up to $11.50 in October. It's trading on about a 3.7% fully franked dividend yield, which is good. And you look at some of the metrics behind the business. No debt on the balance sheet and plenty of cash. A return on equity in the mid 60%.
So that's phenomenal.
It's one of the best I've seen in the market. That they've achieved that sort of virtuous cycle, we call it, where anyone who's selling a second-hand car has to be on car sales because that's where everyone is looking, and it creates this sort of effect which sees them as the dominant player. Daylight, and then a distant sort of second is drive.com.au. And car sales also, we've sort of been speaking to some people in the industry. We think is interesting also that new car sales are the highest that they've ever been. And generally you will see if someone's buying a new car, they'll be trading in or selling their current sort of car, which should lead to strong transactional turnover of second-hand cars, which is great for car sales.
We tend to believe that we'll see in the order of 20% earnings growth over the next couple of years, which will bring down what is a slightly higher PE back to really quite acceptable levels. And we do believe this is also a company which, when it has reported, has tended to exceed expectations, rather than one of those companies that just barely meets or fails to meet expectations. So this is a superior company. We believe the price now is good, and we can begin to be acquiring the stock around these sorts of levels.
And that just finish there is a good point, I think, is that with this one we're probably being a little bit more cautious, where we're sort of recommending to buy a stake in the business. Let's see what the result looks like. It's only a couple of weeks away now, and then to potentially add to that stake, getting up to what we're looking for. So, because the share price has been weakening, and sometimes that can be a sign of something, but we tend to think, given the recent sort of reaffirmation of guidance, that it's probably a good opportunity. And it's a business I think we both wanted to own for a number of years. So
the time is right and the opportunity looks good. So let's get into that and get into the year 2014. We're hoping it'll be a very good year for the market. We think it will be, and we look forward to bringing you the news every month, starting again from February.